On February 28th, U.S. and Israeli strikes eliminated Iran's supreme leader and key officials, and since that time, for the first time actually in modern history, Iran closed the Strait of Hormuz, the narrow choke point through which roughly 20% of the world's seaborne oil travels. We're going to talk about the implications of that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the markets and take your questions. And if you're looking at my screen right now, I'm not telling you anything that you haven't seen before. What this is was the news from February 28th, shortly after the United States and Israel struck Iran in several locations. One of the reasons I thought this map is kind of helpful is that if you're looking at it, you can see where Karg Island is. Karg Island, hopefully this is actually showing with the annotations if I shared the screen correctly. That is sort of the principal offloading and production facility for Iran's oil supply, and I think that's rather important. I'm also going to just quickly show here another interesting thing. I'm just going to end that for a moment, and I'm going to bring up another chart, which I have around here somewhere. Let's see. Okay. So this, I have previously shown the vessel map from Bloomberg. I think this is arguably much better. And the good news is it's also free for you to use. If you're interested, you go to marinetraffic.com. You can look at the exact same screen that I'm looking at here. This is fairly close to real time. It updates periodically. You can see right here is a little countdown clock. This is when it's going to refresh automatically. You can also hit that button and have it refresh. What we can see here is the Strait of Hormuz. This is Hormuz itself, if you can make that out. Oops, not like that, you're not going to. This is Hormuz over here, this little island off the coast by Bandar Abbas. One of the things you're going to notice is that there's not a lot of vessels in this area. Now, this is the normal shipping lane through which the traffic going into and out of the Persian Gulf would typically travel. This distance right here is about 30 kilometers. The shipping lanes themselves are only about 2 miles wide. Now, if we look over here, we can see how many ships were traveling. Now, this is on the 1st, which is actually right after. So this is the first calendar day after the attacks took place. You'll notice that 29 ships transited the strait. Probably one of the reasons was that the strait didn't close immediately, and there were probably many ships in it. But you can see just how precipitously this seaborne traffic fell thereafter. Now, you're going to notice some different color codes here. The color code in blue, sanctioned. Sanctioned means sanctioned by Iran. So if it is blue, sanctioned, that means it may pass with Iran's permission. Now, if we go back to that other, and you'll see that as of yesterday, for example, only 2 ships transited the strait. Both were sanctioned by Iran. If we go back to this, one thing I will point out is that there have been instances, I've actually seen it happen, where you will see one of these ships move. This is coming from AIS data. Suddenly disappears, and then it reappears on the other side. Okay. Now, I wanted then to start just talking a little bit about what the implications for all of this really is, because we are now coming close to, possibly, a correction for the S&P. I bring this up because we are formally into correction territory for the NASDAQ, although not yet for the S&P yet. Suggests that we might actually get to correction territory or worse. Correction territory, formally defined as a decline, peak to trough of 10%. Actually, intraday we're there. I don't think closing data we actually quite got there. So if we look at the closing data, you can see that the intraday high, so this is back on January 28th, and today's intraday low do hit that, but we actually have to close on the lows relative to the prior closing high. I don't know, actually, if that might get there. We'll see. We're very, very close. here's the thing that I wanted everybody to think about, and that is that as crude prices rise, this has a whole bunch of carry-on implications. And this is what's going on. So the average price for crude last year is pretty close to this yellow line. You can see that give or take, based on where we ended the year, we're about $40 higher than that now. Estimates will vary as to how much that impacts inflation, but one can imagine that if oil prices were $40 per barrel higher on average for 2026 than they were for 2025, that the net inflationary effect would be profound. How profound depends on various estimates, but if we figure that you're looking at 30 to 50 basis points of potential inflation per $10 in crude, because it isn't just about energy prices, it isn't just about gasoline prices and logistics and shipping prices, which depend heavily on things like diesel, but it's a necessary feedstock for a lot of things like fertilizer. If fertilizer prices go up, then food prices go up, and so on. So there's a lot of other things that sort of go along with this. And as evidence of that, you can take a look at the 2-year. The U.S. 2-year is probably as good a proxy as any. You know, we sit there and we talk about, oh, how many cuts are implied, and, you know, are we expecting a rate cut? Are we expecting 2? Are we expecting a rate hike? The thing that people really ought to just focus on, I think, if you're trying to keep this easy, just watch the 2-year. If the 2-year is going up, that's a pretty good indication that the expectations for rate cuts are going down. Now, it has fallen from the post-strike highs, as you can see here, but still it's substantially higher than it was before the strikes. How much higher? Well, let's just take a look. It looks like about 40 basis points to me. 45.71 basis points higher. The 10-year, I think, is pretty similar. I'm just going to pull that up as well. And we'll do a similar quick calculation. And that's 41 basis points. So that actually is almost exactly what you don't want, right? So we're seeing rates going higher, and we're seeing the curve flatten a little bit. That means that the front end is going up faster than the back. And the front is going up for inflationary reasons, and the back isn't rising as fast because that is not indicative of real economic growth. So if it flattens or even gets inverted, that's kind of an unhealthy characteristic within the rate markets. Now, the thing is that as rates rise, that's another reason why equities would fall. As the discount rate goes higher, the net present value of future cash flows goes lower. Higher duration equities in particular will be hit. We have seen that somewhat. And I think this is something that's fairly important to remember, that we're basically getting a perfect storm. And then if you combine all of that with consumer and business confidence don't typically improve when you go to war, when energy prices rise, when risk asset prices fall, and you have a lot more geopolitical risk going on. So all of those things, it's not like these are independent items and we're sort of taking them in turn. They're all related to one another. And the reason I suggest I'm bringing all of this to everyone's attention is because if you take a look at the S&P's average returns, this is a century's worth of data right here. 62 basis points is the average return over 30 days, 126 basis points over 60, and 193 basis points is the average return over 90 days. The drawdowns over 30, 60, and 90 days are just under 3%. This is the average drawdown. 4.27 and 5.36. The thing is that once you get into correction territory, and I'm just going to select that here, so again, you're going to see that the 30-day returns actually go down a little bit. And so that's just something to sort of think about. And if we get into, say, formal bear market territory, which I can also, I'll select all of this, and we'll go back to bear market territory. All right. Bear market territory, things get a little bit better. In fact, the 30-day returns are a little bit above average. So if you first get into correction territory, the average returns are actually below average. Get into bear market territory, they get above average. But the moves, the big drawdowns, tend to, the average of these drawdowns would tend to be higher. That shouldn't come as a big surprise. The market's becoming more volatile. The fact that the returns are actually higher probably isn't that surprising either, because you can get these snapback rallies, that sort of thing. But really the broader point that I'm trying to make here is that given the backdrop, which is higher energy prices, geopolitical risk, inflation concerns, rates, and all of that, it's very difficult once you sort of get into that to, potentially avoid further downside. If we consider that generally when the market has a pullback of about this magnitude, maybe 30% of the time, you could fall into a formal bear market. I would have to say that if we give it the same backdrop that we're experiencing right now, we should probably increase the probability that we would assign to that taking place, especially when you consider that valuations weren't exactly cheap coming into this, by about 50%. So what does that translate to? Well, that means that if we were expecting about a 30% probability that this pullback could normally go into a bear market, I think we're probably looking at something closer to 45% probability, or even slightly higher than that. That's a significant probability. It doesn't necessarily mean it's going to happen. It just means that I think there's a greater chance that it will, or that it could happen. So just so that I give everybody not just a bunch of bad news, but a way to think about this, I wanted to offer what I thought would be an interesting way to play this. And this is based on something that I was talking about a week ago, so I just wanted to have a little bit more of a framework for the conversation. So now that just put all the ducks in a row, if you will. This was based on the large SPX put spread that I saw, and I think I highlighted in an earlier video, which was that May 1st, 5,300, 5,200 put spread that we saw in SPX. You can't get quite the same payoff, but I just wanted people to sort of see where these narrow put spreads that fall within the boundaries of peak to trough bear market are as we talk right now. So formally a bear market, if you translate the S&P from its 7,002 highs, 20% pullback, if you translate that into SPY, that would work out to about 558-ish and change. I happen to choose today, in this example, a 15-point put spread. I'm again using the May 1st weeklies. You can see here I'm using the 575, 560s. Remember that 558 is technically that bear market threshold. This is costing about $1.28, which is about the same distance between the strikes that SPX trade was, but obviously a much narrower distance in terms of dollars. But that still works out to a payoff of about 10.7 to 1. So here's another way to think about 10.7 to 1. If that represents an 11 to 12% decline from here, and you allocated 75 basis points, 10.7 times 75 basis points works out to a little over 8%. Put differently, a bear market being formally about 12% lower than here, a 75% portfolio allocation to a trade like this one mitigates about 2/3 of that decline. At which point, I have to say that I think the market becomes a lot more interesting, a lot more compelling. So definitely something to think about on that. Okay, so let me now, having said and done all that, I am going to make sure that I bring up the social media thing here. Okay. Jim Howard, hi Mike. Like when you do a fresh Bloomberg terminal screening, find a stock you like and set up whatever type of trade you like best in options play if you are up for it. Yes, happy to do that, and we can go through this situation. And then Finn West, howdy Mike, I appreciated your special broadcast on regime changes to leverage off of Jim's request. An updated look at your stock scan would be useful. The last time was in February. I will do that scan for us right now. And Monday Morning Quarterback, nice mock speech on options edge. Unfortunately, contrition is a 4-letter word for this administration. Yeah, so let me offer this, which is, some of you may not subscribe to the options edge, so you may not know what Monday Morning Quarterback is referring to. Basically what I said, and I want to emphasize something here, which is that there are a lot of differing political views about what's going on in the Middle East, and there are many legitimate perspectives. Okay, so I'm not making a definitive judgment, nor is it my place to, on whether or not Iran represented a, quote, imminent threat or not, as has been used as the justification for these strikes. I think a lot of the things that are used as evidence, though, that it was an imminent threat are things that we have commonly heard in the past. I think in 2021, Senator Chris Murphy from Connecticut described Iran as an imminent threat. I think our former Secretary of Defense under the Biden administration described them as an imminent threat. The IAEA has said repeatedly that there was no justification for the level of uranium enrichment that they had and the quantities of it that they did. And Iran itself indicated that they had enriched uranium that could be used to create 11 nuclear weapons, and in relatively short order. All of these things have been true for a while. So why they're an imminent threat at this point may be dependent on information or data to which I'm not privy. There's a lot of things I don't know and will never know. But really, the point that I'm trying to make is that there are a lot of global economic consequences, and really it's my responsibility to try to think about what those might be. And they are profound. And it is a lot easier to be disruptive and to destroy things than it is to maintain, sort of world order. So while it's very easy to start a military conflict, it can be a lot harder to end it. And the reason it's harder to end it is because one or two people can start something, or one or two countries in this case, but all the parties to it have to agree to stop, ultimately, for things to normalize to the extent that they can. What I had put into that speech was that, and this is not common as far as I've seen too often from politicians, to say that there are things we don't know and there are things we can't do, because that's not usually why people get elected, to turn around and say, there are things we wish could happen, there are things we would like to be able to do, but wishes don't create reality. And so my thinking on that was that if the objective here is to avoid economic disruption, to reopen the strait, then one of the things that the United States can do, because it cannot control what others will do, it can only control what the United States does, Israel can control what Israel does, would be to take a step back. It is very difficult to negotiate while you're lobbing missiles and bombs. And there are limits to what we can do. So the simple thing that I had suggested was, one thing that could be done would be to step back and withdraw from military action at this point, and maybe even move some of our military apparatus further from the point of conflict right now in an effort to essentially kickstart a negotiation with Iran. Would that actually do it? Would it mean that they would reopen the strait? I don't know. But I think that one thing that the markets don't like the idea of, so this is not, I think most Americans don't either, but the idea of boots on the ground is probably not something that appeals to the markets, and I don't think it appeals to many Americans, and it is not clear that that would solve these problems, that it would get things reopened. My guess is that we would end up with continued strikes against critical infrastructure in the Gulf. That could include desalination plants. It could include other material and important production facilities beyond the one that was already struck in Qatar, which is material. Supposedly 17% of their LNG production possibly taken offline for as much as 3 to 5 years. That's an article I read in CNBC about the topic. I think Reuters did one too. This isn't something that the world needs or wants. So there are plenty of things that we wish we had. Peace in the Persian Gulf and prosperity for all. Those are all nice ideas, arguably not realistic. But I also wonder whether negotiation is entirely realistic while we're actively engaged in conflict. And this is probably more true when one considers that Iran, in their current state, is meaningfully disrupted. The leadership has been shifting. I don't know what their command and control and communications look like internally. But if there's massive disarray there, and I have reason to believe that there probably is at least significant disarray, it's very difficult for us to negotiate and sort of try to make some progress. And again, that's not a judgment about who's right or wrong in this. I'm just simply making an observation that I think that the markets would probably prefer that we see some de-escalation. Whether that's the right course from a political standpoint, from a moral standpoint, I will leave it to others to judge. Okay, so with that all said, why don't we just move on and do what we were just talking about. So I'm going to take the Russell as our starting point. And I'm going to guess that from a technical point of view, you're going to find a lot fewer stocks are above the 200-day, which is often where I start. So we might end up sort of preemptive. Let's take a look. So we've only got about a third of the Russell is above the 200. And if we're looking for an RSI, let's say we want it to be between 30 and 70. I think this is how I do that. What did I do here? Well, that's okay. I can do that filtering in just a moment. Okay, so we'll start with over the 200-day. We'll start with valuations with a PEG ratio below average, so 2.5. That seems fine. That already gets us down to 171 stocks. We are looking for companies that are actually getting some growth. So it would be nice if earnings growth has been positive over the last 12 months than over the previous 5 years. I'm going to leave that one alone for just a moment. The rationale is I'm curious to see what names come up here, because you're going to notice that Cheniere Energy over here. So Cheniere, ticker LNG, if you're not familiar, these are companies that could be materially impacted by what's going on. And I don't want to filter it out simply based on what happened over the last 12 months. But instead, we're going to look at this with a little bit more discrimination once once we figure out what's going on here. So I'm going to leave that alone. I will say that it would be nice if we have at least, I don't want to see companies that have negative earnings growth. So, although you got Baker Hughes in here, so that's going to be interesting. Deere, I think we've got some companies down here that are probably going to be pressed a little bit. But you can see, if you take a look, that a lot of things where we are not getting sort of that positive recent revenue number, which is something I'm normally looking for, but these are not entirely normal times. So that's a filter I'm not necessarily going to impose just yet. All right. And the other thing that we typically look for is we'd like to see positive revenue and earnings projections. And I am going to put that in because presumably this is a 3-month change, but I'm only going to look at 1 month because what we're really interested in right now is everything that's happened since February 28th. So there's actually a lot of utility, I guess, in us having this conversation right now, because one of the things you're going to see is that when you, or at least when I, see unusual circumstances like the ones that we're currently experiencing, I will, oops, what did I just do? I put that 0 into the wrong place. Well, that's terrific. So we'll begin that again. But I don't need to explain everything that I did before. So I'm just going to go back and throw these things in really quickly. So I want a price over. It's got to be above the 200. My normal actuals, I'm not going to do that. Estimates, I want to see this greater than 0. I would like to see this greater than 0. And on the valuation front, I was looking for pegs less than 2.5. All right. And let's see what else. There was something else I think I had done. What was it? Don't quite remember. Well, we're down to 85 stocks. So why don't we start with that as a good starting point. So I'm going to bring these in now. And so I'm going to rule some of these things out straight away. Everybody may have their own views. I'm going to just exclude Intel because I'm still unconvinced, shall we say, about their sort of pivot back. That's a little bit of a challenge. I am going to leave Deere out of this, a company which I have historically liked a bit, but I find it very difficult to imagine with rising fuel costs and rising fertilizer costs and rising interest rates that now is the time that farmers are going to really start investing in new equipment. That just doesn't strike me, right? And again, I'm just looking for a simple way to sort of cull this list down to something that seems a little bit more reasonable. It just seems hard for me to imagine that that's going to be a big positive. FedEx is on this list. You'll notice down here, I just saw it. Where did I see it? Here it is. We're going to take a quick peek at this, and then I'm going to just offer, once we take a look at what the charts are telling us, some of the things that I would just say from a fundamental standpoint strike me as a bit troubling here. So it's above the 200-day, but you're raising fuel costs, you're pressuring consumers. There's a lot here that makes this one a little bit troubling to me. It has broken through the 50. My guess is that we're probably going to test the 100 and maybe the 200 before we break right back through that, unless there's some really good news. So that's another one that I can almost immediately say, okay, I'm not gonna look at that one. Energy names in general, many of these have really rallied pretty significantly. By the way, if fertilizer and things like that are going up, then we can also expect grain costs to go up. If grain costs are going up, then that's an input cost for like the Smithfield, which I just saw in here. That's a potential thing that we might want to be taking a look at. Constellation Brands, actually, let's just take a quick peek here at Constellation because I don't know if this thing's gotten cheap enough yet. It has definitely gotten a little bit cheaper. It is struggling to get above and stay above this 200, but it does feel like it's catching a little bit of a bit here. Many people will know that the issue here with Constellation is that the trends in alcohol consumption are not in Constellation's favor. But I am curious just whether we might be getting to a situation where a potential bearish to bullish reversal is taking place. We can see that it got above the 50. It's back below it. It seems like it's trying, possibly. So that's a name that I might consider and we'll maybe frame up a trade on that. So let's consider Constellation as a place that we might play. We've talked plenty, I think, about energy and gold, so I almost think that maybe we can just leave those out of here for now. And I'm not usually the type to start playing in the biotech or space. I'm going to leave it to others who know more about that than I do. So maybe we can frame something up in, yeah, perhaps we'll take a look at, let's take a look at Constellation. And also Southern Copper was a name that I did like. Let's see how badly that's been. So a lot of these types of businesses did get hit. We saw the precious metals in particularly roll over. We had that big run up and then they fell back. But this looks like it might be bouncing off the 150. So this is another one that I would consider on the long side. Is that about there? Yeah. Okay. So let's do that. All right. So we'll take a look at Constellation as a potential bearish to bullish, and we'll look at Southern Copper coming back to a longer-term trend line as two ways to potentially play in here. Now, of course, higher energy costs. That's an impact for the miners. In fact, one of the things that the miners really had going for them was that they were seeing the value of the commodities they sell skyrocket, and they're at the exact same moment that their input costs in forms of energy and things like that were static to falling. And now we've had exactly the opposite. Let me, as an example, we can take a look at gold over here as well. So this is going to be gold and silver. Had these sort of bull, parabolic runs, came back. Gold, parabolic run, came back. Copper, not quite as big a run, but it came back. They all seem to be trundling along, though, still for the time being holding above the 200. I think that's kind of an important thing for us to be looking at. So just bear in mind that if you get into something in Southern Copper, this is something we care about, right? So, how is silver doing relative to its 200? How's gold doing relative to its 200? How's copper doing relative to its 200? All of them are coming back right to that. They're still in an upward trend. That's good. This is inflationary. That is generally good. In copper's case, as we look at this, we have to recognize that higher rates, lowering consumer confidence, lowering business confidence, higher energy costs, those things can potentially reduce industrial use. So, these are the kind of the factors that we're dealing with. That's also one of the reasons why we're getting it at a fairly big discount. How big a discount? Well, you can see how high Southern Copper got. I mean, at its peak, we're down almost 30%. So this is an example of one of the names that has fallen formally into its own personal little bear market. But let's bring up options play. What's the date today? The 30th? You know what? Let's do one final little test here. Buy and hold, good. Some of these other metrics not as good. Bollinger Bands, perhaps. So there's kind of a mixed bag on that one. Mixed bag here. Constellation does seem like there's maybe a little, few more technical indicators are on the positive side. So let's start with that one, yeah? Oh, and I need to do something else, which I did not. Let's take a look at the event calendar for Constellation. So they're going to be reporting on April 8th. So that's coming right up. Are the options markets implying a larger or smaller move? 5.73%. Given some of the moves that we've seen in the last 8 quarters, not totally ridiculous. But we can see here that just the last 4 quarters in particular, that's a little bit rich, given that, right? So if we look at this, call it 5, 10, 11. Yeah, I mean, it's like, we're looking at an average move between all of these of about, 3% or thereabouts. So we have 1 over 5, one about 4.5, and then these two are big nothing burgers. So, but generally fairly positive. So, with that, let's just also take a look at what the revenue trajectory is here, because I know that it's been negative just due to this, the falling trends on the alcohol side. But it does look like the hope and expectation is that things are going to stabilize and maybe get back to very modest or moderate growth. We're looking at it in terms of free cash flow. So let's just call it $2 billion. 5.4% free cash flow yield for next year, which, if that's true, would represent about 12.2% year-on-year free cash flow growth. Not terrible. Top line growth numbers, not great, but if we figure that over the next 12 months, now bear in mind we're at the end of March now, the next 12 months, we're really probably looking at about $12.50 of EPS if their numbers hold up. So if we can at least get back to where their top line is holding up with inflation, that would be nice. But that's a PE of 12. So 5.4% free cash flow yield anticipated for next year. PE of 12. We have a 2.7% anticipated dividend yield. And cheaper than Brown-Forman, cheaper than Boston Beer Works. Molson, wow, PE of 4. Wow, that is really something, huh? Okay, so my thinking on that is that if you are inclined to play it for, another post-quarterly earnings release, decent kind of a trade. Not surprising, by the way. You can see the technicals here are neutral. But as you saw in Bloomberg, the better performing technical indicators were generally bullish. So we're going to lean on the bullish side. Options prices with a nearly 6% implied move, probably a little overpriced. So we don't mind being net short options. So, this would be one of those situations where, something like a call spread risky might make some sense. 170, a $20 move, that seems a little ambitious. Let's go back to this for a second and see how big the post-earnings moves have been if we extend that out a little bit more. So I'm just going to look at a month after earnings. What have we got in here? So in the last 4 quarters, the last quarter we did get a almost 18% rally. All right, well, 15% gets you up to just over 170. All right, so maybe the 170 calls aren't such a bad one to sell. Let's see here. And maybe go down to something like that. There we go. So, and let's go back to the chart. Let's see what this looks like. So we've got a 140, 55, 70 call spread risky. So, and now we're going to just take a quick peek here and say, All right, so if you had the stock put to you at 140, how do we feel about that? So 140 gets us right into this region here. I'm going to go out to 5 years. Let's take a look at it in that respect. You know what? Let's go all the way back. So what we're going to be contending with then at that 140 level, that it would include, that's this area right in here. That's the pandemic plunge low. Also curious, so 10 years ago, stock was trading about the same level that it is now. How much was the company actually bringing in 10 years ago? $6 billion, but $3.90 a share, 14.5% margins. Now we're looking for 23. That's another thing for us to just sort of skim through this. Let's just take a look at the history of its net income margins and see whether the estimates that we're basing our assessment on look ambitious or not. It does not appear that way to me. I think that seems like a reasonable margin assumption. There were periods when it was a bit lower. In general, it's been as high or higher. Okay. So there we have it. So that's trade number 1. Let's see if we can find another one. No, oh, that's interesting. Lockheed Martin is showing up on the list. And I would have to feel like that thing has already had quite a tear. So it's not that surprising. So AGCO, by the way, another tractor company. Cat, not quite I don't feel quite the same way about Caterpillar as I do about the agricultural ones, because I just feel like this is an environment that's going to be difficult for farming, because you just have a lot of things working in concert with one another. It can be a little bit challenging. So I can see why they might withhold. Let's take a look here. Smithfield Foods. That thing is... Let's have a look at that. This also is going to have some input cost problems. Is it cheap enough? No, it's already gotten a big pop off of this. Let's see. Oh, it actually did break out above that prior high, though. That's interesting. Okay, well, we can think about that one. Oh, Align, Align showed up here. I don't know if you guys are familiar with this company. I was looking at this about 2 weeks ago. So Align is the company that sells orthodontic appliances, basically, the Invisalign, things like that. And I was wondering if it can hold in here, whether it might finally also be making a bearish to bullish reversal. It seems awfully close. It's still holding above the 200 right here. And this was not a cheap stock originally, but valuation-wise, it's getting a little bit more reasonable now, as we can see. Because if we go back to that, let me show you what we're looking at here, because I think this is kind of interesting. This is one that I happen to be looking at about 10 days ago. So if you go back to these prior highs, okay, so there we are, 2021, 2022. Okay, so let's just take a look at what the multiple was for that thing back then, when everybody was so wildly enthusiastic about it. So 2021, 2022, we're looking at a valuation of 52 billion bucks. Okay, 52 billion on just shy of 4 billion in revenues and $10 a share. Now, it has grown a little bit since then, or at least that's the expectation for next year, or this year, I should say, forecasting $11 a share, at which point it's trading just 15 times earnings, modest growth rate, and a very reasonable free cash flow yield. I guess my point is that at these types of numbers, it doesn't really have to prove a whole lot. It basically just has to hold up with expectations where we are right now. Decent cash position, as you can see, net about $1 billion in cash. So that is another possibility. Let's see when they're going to be reporting on the long side. Again, high implied volatility, 60, so we probably get some pretty nice break-evens on something like a call spread risky or even just a short premium trade, selling some cash-covered puts. They are going to be reporting at the end of April, so almost exactly a month away. If we went out to April again, this is going to be one where let's see what that looks like. So how do we feel about just maybe selling a cash-covered put? I might get down in this neighborhood over here, something like that, 160, 165. 165 at the money, 1225 standstill rate of return. 7.4% standstill rate of return for a cash-covered put. And the downside is that you would get net long the stock very close to 150, which is right in here. So not an unreasonable level, it would seem. So there's another kind of interesting trade. Not super exciting. And again, here's what we're dealing with, right? So the trend looks bearish in this, or neutral to bearish. That's actually better than the market overall. The market overall just feels very heavy to me. And it's one of the reasons why I was talking about that tail risk hedge. Okay, so let's take a look at what else we got here. Marvell. Yeah, Marvell, that showed up on the list, as I'm sure that's probably why you're mentioning it. My issue with Marvell, and I don't, we'll come up with some things on this. My issue with this is that if we do get rates going a whole lot higher and people get a whole lot more panicky, it's the high duration stuff that tends to get chopped up quite a bit. I mean, I don't think I need to show you a whole lot more evidence than this. That's a pretty big drawdown, folks, for a single day. Let's have a look at this one. That's still above the averages, though. I mean, that is moving. I mean, this thing was over $100 on just 2 trading days ago, and here we are at 87. So that's a meaningful decline. Got some time before we get next earnings result. These numbers all look great. Really good. Love those growth numbers. Love the free cash flow growth. But this is certainly much more of a hold on to your hat kind of situation, because this is whipping, right? More than 13% move in 2 trading days. Maybe, let's see if we have a term structure we can kind of play along with here. If it's steep in the front. So perhaps a way to play this would be with a calendar. buying some longer dated call options rather than just simply buying the stock to give a little bit more of a cushion. And then let's see if we can see how that looks. Still, 60% implied volatility long term. That's going to be an expensive long dated option. So we'll examine that. If we were to buy, let's just go out to September for the sake of argument. And you can see you're looking at 15% plus of the current stock price to buy that call option. So if we're going to try to sell something a little nearer dated against it, better really hope we can find something fairly compelling. I'm not sure if that's super compelling, but the upside break even of 100 is right where we were before. What were these lows right here? That was 70. Can I get anything for a short 70 put of similar expiration, at least enough to make it worth doing? Then you end up with a structure that looks a little bit like this. Probably gets you some standstill rate of decay. So what I'm trying to take advantage of here is just the fact that there is a big bid to short dated implied volatility. This is probably one that you wouldn't necessarily either need or want to ride all the way to expiration. But bear in mind that because they're reporting a little bit later, how much decay this experiences over the course of the next 3 weeks, which is normally kind of that sweet spot. You sell a 45-day option, you cover it with 14 to 21 days to go. If we are still in the thick of the uncertainty that we're contending with now, there's going to be a bid to volatility generally, and because those options will still capture the upcoming catalyst from Marvell, there's going to be a bid to those too. But this might be a way to play it that I think is okay, because in the worst case, the stock drops down and you're basically taking net long stock position at 70, which is a pretty good discount to where the stock is now. About a 20% drop from here. That's going to be a full 30% drop from the highs that the stock was trading at just 2 trading days ago, right? So, but I mean, it's very hard to argue against the near-term fundamentals in this business. I mean, they're growing the top line at 30% plus, generating free cash flow like nobody's business, and it's not massively expensive. So it's not like it's pricing that to go on for 30 years. It doesn't have to make it reasonably valued at these kinds of multiples, those kinds of growth rates. So there's a potential way to play that. All right, so yeah, January punter call. One long call option expiration. What is your pick? That's a good one. Let's see. Kind of guessing. Let's see. That's bouncing on the 200. I'm not sure that's quite where I want to be. I'm looking for something that's also bounced, come right back to his 200. I'm looking for a punter call. I'm looking for something that's just gotten beaten up. That would certainly be contrarian, right? I kind of feel like something like that is where I want to pick something where I'm just a bit contrarian and going to say, okay, I think this thing could actually could make a comeback. Let's see. Just putting a couple chips on the board and saying, all right, I just want to own this thing for a potential rebound. could this thing... I might play in here. This is absolutely about as contrarian as you can get. I mean, this is just looks like grim death, but we're at 37. We've got that other fib at 34-ish. Problem with this one is that the implied volatility means that the thing's really got to go. I might do something like a just a straight risk reversal on this. Let's see if we can see what that looks like. See what we get. So we want to sell that, sell. And what I might think about doing in something like this would be legging my way in. So let's say we'll lift that call. All right. So I might look at something like this, where I would, lift a call in here on the upside, and basically be hovering over selling a downside put. So if we get some further weakness, and I can sell a 27.5, a 30 strike put in here to offset it on some weakness, that would be something that I could kind of get behind. Because the things where I would be inclined to buy a longer dated call like that are going to be those places where I want to have some exposure, but I remain skeptical, but know that if it does catch a bid, it can move really, really sharply. So, honestly, something like crypto would be a place like that I think fits the bill for something like that. And then just look for an opportunity to lean into it with some short premium. If it falls off a little bit, you can try to sell some downside puts to help finance it. If it catches a bid, you could keep the long call on and sell some upside calls against it in that instance, particularly if you start seeing that big inverted yield curve. Another reason that you would buy calls is because this is one of those catching the falling knife situations, right? You don't want to become fully committed on something that you think probably deserves and may actually experience a little bit of a bid. Unless you're Warren Buffett and the gang over at Berkshire and you are ready, willing, and able to buy the whole company. Catching the falling knife isn't something that you really want to get into on the long equity side, although you can buy bits and pieces. But buying call options, as in the case I'm having here, are 30 delta call options. What that means is that in the short term, if this thing gives up another 10%, your calls are going to lose about 3% of that value, give or take. And it'll probably be slightly less. You have to factor in the time as well. And then just sell some near-dated premium against it. So you're going to be long gamma, not a lot of gamma because it's a long-dated call option. But that might be a place where I think optionality makes sense, and it's probably worth the high price that they're charging. Tucker D. Dog says SNRs. I think you mean SMRs, small modular reactors. Is how we usually refer to those. Oklo, VST, SMR, all down. Yeah, in general, I kind of like that. I like that space. I think you can also play that on the uranium side. I think this just re-emphasizes how important alternative energy is. But it's, we're a long way. I mean, SMR, which is New Scale, they have yet to build any. I think they had a tentative deal for a while. Was it in Washington? And that sort of came to naught. I really would like to see at least one of these projects get off the ground because these are all pre-revenue. So it would be nice. I think this is an important strategic thing that the United States needs to be engaged in everywhere, frankly. I mean, we have well and truly illustrated now. Actually, you know what? Where did I had that chart. I probably killed it. Oh yeah, this thing. So hang on, let's see. I had, let's see, global commodity prices. Where is this commodity spot? I wanted to show you guys a chart, which I thought was kind of interesting. I'm going to take a look at, so check this out. Just to show how, what kind of a strategic weakness if I can get this thing to do it. Look at this chart. This, I think, is really quite interesting. All right? Let me get rid of the moving averages here. All right? So, natural gas, this is in Holland, in Dutch natural gas. You can see right here we've certainly caught a bid off of what is currently going on. But notice how small that looks compared to what has happened in the past. What's going on here? So, this period right here, Russia is building up military forces outside of Ukraine, tail end of 2021. This, Russia actually invades, goes in. This, destruction of the Nord Stream pipeline. Look how high that is compared to where it was only just recently. 31. So remember that in Europe, it's obviously in euros, but they also price it off of megawatts. And actually, it's a little bit peculiar because the Dutch contracts have a different number of megawatt hours per month. So you have to do two translations to convert it to the way we think about natural gas prices, which is going to be dollars per million British thermal units. But this level right here, where they are right now, is like 5x what natural gas prices are in the United States. And this right here is almost 7x, at least 6x what that is. All right, so we're talking about 30 times higher is what that worked out to. If that doesn't alert you to the need for some measure of energy security and independence, I don't know what does. You just simply can't have that kind of thing. So on the SMR front, that does make some sense to me. VST, by the way, Vistra, which you mentioned, so very different business, right? So you're looking at Vistra on the generation side versus SMR, which is New Scale. New Scale is a pre-revenue company. Vistra actually is far from pre-revenue. They've actually growing the top line and the bottom line quite nicely, as we can see here. And not an obscene valuation either. Look at this, 2027 numbers, almost $11 a share, even if we're just taking a look at full year for this year. Or next 12 months. If we use next 12-month numbers, that's going to be $9, probably, right? So that means that I'm not including the past quarter and including one that follows. But that gets you to, 16 times forward. Free cash flow in the neighborhood of, well, let's just call it 3.6 over 71. 5% free cash flow yield. So Vistra, I like it. And it's gotten a heck of a lot cheaper. So yeah, I think that's fine. The graph, this is not the best picture you've ever seen, but we are right back in this neighborhood here, and you would have said to yourself at the beginning of this year, and certainly in the mid 2025, frenzy of, oh my gosh, you know, the electrical generation is going to be so valuable because of all the data center stuff. If someone had said, oh, well, by the way, you can buy this thing at a roughly 30% discount to the current stock price, that, you know, that's here or here or here, back where it was trading back in 2024, you'd have said, of course. Technically, I mean, it's not exactly back up the truck time from that respect, but it is certainly very reasonably valued, I think we can safely say. Where might this back to? 1.7. So it needs to hold right in here at this 141 level. Otherwise, you know, this could be the next port of call down here around 118. But I think that it does make sense to start picking up things that make strategic sense, as that does. So, yeah. All right. Well, I want to thank all of you for tuning in. And also thank you to those who didn't tune in but are watching this recorded a little bit later. Please like, subscribe, hit the notification bell, tell your friends. If we get more people watching this, it makes it a whole lot easier to justify doing it. And be sure to put your questions into the comment section for these videos, because if you do that, then I'll have an opportunity not just to respond to the questions and do so off the cuff like this, but I have a window to give it a little bit more thought, maybe assemble some more collateral. It's one of the reasons why I've kind of been talking about the same thing a couple of different times with respect to oil, with respect to rates, with respect to everything that's going on in the Gulf, because I'll talk about it and then, you know, a few moments later I'm thinking, oh, you know what, I really need to tie this together just a little bit more so that people can understand that 30 to 50 basis point increase in inflation rates that a $10 increase in average oil prices per barrel over the course of a year add. Didn't mention it before, so I'll mention it now. And that's why I keep coming back to it. But if you give your questions in the comment section, I'm not going to be talking and then backtracking. You know, I can put all that together ahead of time and then share it with all of you. So until that time, thanks for watching. And come back for office hours tomorrow with Professor Mark Guthner. Thanks for watching.